The third quarter of the year continued in a similar vein to the second quarter, with a difficult period for markets globally being reflected in the performance of the Factor series funds. In fact, this quarter brought with it an acceleration of the falls experienced in the previous 3 months as concerns grew over global growth rates, especially in the emerging markets. In the end, the past quarter was the weakest for global markets since the euro crisis reared its head in 2011. To put this into context, the UK equity market was down 6.7% for the quarter, whereas Factor 3 was down 2.8%, Factor 4 down by 4.7%, and Factor 5 down 5.8% net of all fees. Over the quarter, the portfolio's returns benefited from the exposure to global ex-UK stocks, that is markets outside of the UK, as these outperformed the UK market in sterling terms. This benefit was only modest though, as these markets still failed to provide positive absolute returns over what was a difficult quarter. The performance of the portfolios would have benefited from a greater allocation to UK gilts or indeed global sovereigns over the quarter, but we keep this allocation relatively low on the basis that these assets will likely deliver unattractive returns in a rising interest rate environment. A large proportion of the credit strategies held in the fund are global in nature though, and this aided performance as sterling's weakness over the quarter provided a tailwind to foreign currency returns when translated back into sterling reporting currency. Within the fixed income allocation of the funds, the relatively low interest rate sensitivity, or duration as it's known, did not aid performance as interest rates fell as risk aversion grew. We've made some small changes to the allocation of the portfolios over the quarter. As markets have fallen, we've moved to a slightly more aggressive stance as we look to take advantage of asset classes becoming more attractively valued on the back of the falls. For example, we've re-established a position in Japanese equity on the basis that the market had been weighed upon by broader Asian concerns and now represent an attractive valuation level. Overall, the portfolios remain allocated to a balanced mix of global equity strategies, and these have complementary and somewhat offsetting characteristics, which together creates what we believe to be an optimum allocation to the global equity market. We remain underweight US equities because we believe them to be expensive. There's still a lot of good news priced into the US market, and we think there's a greater risk of disappointment either from the corporate sector or macroeconomic data when compared to other major markets such as the UK, Europe or Japan, as we've already mentioned. Within the fixed income buckets, we're underweight government bonds and overweight a variety of areas of the credit spectrum, including investment grade, high yield, convertible debt, emerging market debt and loans. We retain a reasonable cash balance as it represents modest value compared to government bonds, and it's also useful to put to work as and when opportunities present themselves, as they did in the past quarter. It seems to me that markets have adjusted rapidly to the slower growth in the global economy and have fallen faster than fundamentals in the past few months. Recent economic trends suggest this cycle will be extended much further, with continuing very low interest rates across the developed world, the near certainty of additional central bank support if growth falters, and the prospect of a continuing subdued but stable recovery in the US, UK, Europe and Japan. Nowhere across the developed world can we see conditions which could cause a sharp tightening of monetary policy in the foreseeable future. We believe the worst is over in this latest risk-off period. There are clearly significant imbalances across the world and a high level of uncertainty, not least around the ultimate endgame of this long period of extraordinary monetary policy, and this will keep volatility at high levels. But for longer-term investors, volatility creates opportunities to add to investments at attractive levels, and we've been using the falls in recent weeks to add to our risk positions in portfolios, especially in equity markets. As we enter the final quarter of the year, there are attractive opportunities at much improved valuation levels across many markets, and we anticipate better returns after a difficult period for investors.